Have you ever looked at your bank account after a completely normal month and wondered where all the money went? You didn't buy a private jet. You didn't blow 10 grand at a casino. You just lived a normal life. Groceries, a few meals out, maybe a new phone because your old one was getting slow. But here is the stake. If you are in your 30s and your bank account balance hovers around the same depressing number every month, you are paying a status tax that is quietly lighting your future on fire. Today, I'm going to promise you this. I will show you the exact mathematical formula that separates wealth pretenders from wealth builders. You will learn why the very things you bought to look successful are the exact reasons you'll stay broke. And I'll give you a 5-step system to reclaim $1,000 a month, starting with your next paycheck. My name is Mark Fletcher, and I spend way too much time analyzing why some people escape the financial hamster wheel while others run on it their entire lives. If you're tired of watching your money disappear as fast as you earn it, hit that subscribe button. Welcome to your 30s. This is the decade where life decides to throw everything at you at once. One minute you're celebrating a raise, and the next, your bank account is getting pulled in 17 different directions like a financial piñata. Kids need college funds, houses need down payments, and somehow you're supposed to maintain your sanity through it all. Most people think their 20s were the time to figure it out, but in your 30s, you realize you actually needed to have figured it out 5 years ago. Ask yourself, are you buying things because they improve your life, or because you're afraid of what people will think if you don't own them? There is a dangerous, intoxicating feeling that happens in your 30s. I call it the illusion of arrival. You finally hit a decent salary, maybe $80,000, $100,000, or even $150,000. Your brain immediately starts playing tricks on you. It says clearly, I'm doing something right. I deserve to celebrate. This is when you start paying the status tax. This is when you buy the $200 designer t-shirt that is the exact same cotton as the $10 generic version, just because it has a logo that screams, I've made it. But here's the brutal truth. Respect comes from character, not the brand of your handbag. Most people are spending money on things that depreciate in value just so they can look successful to strangers who don't even care about them. The reality check. The median net worth for households under 35 is less than $39,000. If you have a $70,000 truck in the driveway but less than 40 grand in total assets, you aren't successful. You are a wealth pretender trapped in what I call broke life premium. You are paying extra for the appearance of success while staying one check engine light away from a midnight anxiety session. Think about the average American household. They spend $691 a month on food, including dining out. If you could reduce that by just 25% through meal planning, you'd free up $150 a month. $150 a month invested at an 8% return becomes over $230,000 in 30 years. Is that $80 dinner really worth $250,000? Let's talk about the biggest status tax of all, the average new car payment, which has climbed to a staggering $742. Dealers have mastered the art of making unaffordable cars seem affordable by stretching loans to 6, 7, or even 8 years. They don't sell you transportation. They sell you a lifestyle dream. You see the commercial of the truck climbing a mountain and you think, that's who I am, even though the closest you get to off-roading is parking on the grass at a county fair. If you buy a $55,000 truck on a 7-year loan, you'll spend roughly $130,000 over 7 years when you include insurance, gas, and maintenance. At the end of those 7 years, you'll own a vehicle worth maybe $15,000. You just paid $115,000 for the privilege of driving a $15,000 machine. That's not a car. That's wealth destruction with cup holders. If you took that $800 monthly payment and invested it in a simple index fund earning 8%, you'd have over $70,000 in just 7 years. You could buy 2 reliable used cars in cash with that growth alone. In your 30s, the social pressure to buy a home is a tidal wave. But the math in 2026 is brutal. A $500,000 house is now called a starter home, even if it's a 1,200 square feet box with beige carpet. If you put 10% down, your total monthly housing cost, including principal, interest, property taxes, insurance, maintenance, and the poverty tax known as PMI, will land around $4,367 per month. Most people stretch to buy these homes anyway. They spend 46% of their take-home pay on a roof. They become a prisoner in their own home, working 60 hours a week to pay for walls they're too stressed to appreciate. Real wealth is freedom, not equity you can't access because you're trapped by the asset. We've all accepted that $20 for a fast food meal is normal. We've accepted that $150 a month for cable and 6 different streaming services is normal. When you add them up, you're paying $1,000 a year for television you barely watch. People pay $60 a month for a gym membership they stopped using in February because canceling feels like admitting defeat. That's another $700 a year gone. These aren't just expenses, they're leaks in your financial bucket. You can pour water in all day long by working overtime, but if you don't plug the holes, the bucket stays empty. $742 for the car, $400 for dining out, $80 for streaming. You are paying nearly $1,300 a month in status tax and convenience fees. That is the difference between retiring at 50 and working until you're 80. Why does all of this matter? Because once you hit $100K, the rules of the game change. The first $100,000 is the hardest because you are doing all the heavy lifting. Roughly 62% of that first $100,000 comes directly from your contributions. But once you hit that milestone, compound interest stops being a whisper and starts being a roar. Reaching $100,000 means you are mathematically 1/3 of the way to $1 million. It took you 12 years to get to $100,000, but it only takes about 6 more years to double it to $200,000. By the final stretch, 80% of your wealth comes from compound growth, not your labor. You start earning $80,000 a year just by waking up. But you will never see that magic if you are too busy paying interest on a luxury SUV. Most people think they're 10% of the way to $1 million at $100,000. They're wrong. You're at the 33% mark because of the snowball effect. The secret to building wealth isn't willpower. Willpower is a muscle that gets tired. By Thursday evening, after a long week of career pressure, your willpower is gone, and you're ordering DoorDash. You need a payday routine. The moment your check hits your account, you have exactly 15 seconds before your brain starts mentally spending it. Are you paying your future self first, or are you paying the bank, the car dealership, and the streaming services first? Reaching these milestones requires an identity shift. You have to stop being a person who buys things and start being a person who buys choices. Wealthy people don't drive expensive cars because they need to prove they are rich. They drive reasonable cars because they'd rather own assets that increase their wealth than assets that drain it. They understand that every dollar spent on impressing people they don't like is a dollar that isn't working for their future. 36 years from now, you will either be thanking your younger self or wondering what could have been. You can either look wealthy or be wealthy. For most people, you can't do both. Choose the freedom to wake up and decide what to do with your day. Choose the peace of mind that comes from knowing a car repair won't bankrupt you. Choose to stop paying the status tax. If you're ready to stop being a financial sleepwalker, hit the like button and subscribe.